All right. Before we start this, I just want to pray over myself and over the viewers so that you may receive the necessary understanding and comprehension of what I'm about to get into. Dear Heavenly Father, who is in heaven, I come before you on this good afternoon in Jesus Christ's name. Father, please help us to understand what is about to be spoken. Lord, help me to be informative and knowledgeable to my viewers and supporters. Please impart in them, in their vessels, the ability to understand and comprehend what I'm about to say. Lord, please fill them with trading wisdom, trading understanding, and a trading spirit. May you fill us with your wisdom, Lord. May you fill us with your understanding and knowledge. May the Holy Spirit be with us to help us understand and help us to make clear sense of what is going on the chart. May the Lord's wisdom help us become better traders. May the Lord's knowledge help us to understand what we are doing and what we are seeing on the chart. May the trading spirit be imparted onto our vessels. In Jesus Christ's name, I pray. Amen. So, in today's video, we are going to talk about market structure. And that's going to be the first lesson of the series of lessons that I will be putting out there throughout the year. So, let's talk market structure. Market structure is going to be the first lesson that we are going to look at. In my opinion, market structure is one of the strongest confirmations that a market is going to be trending higher or lower. When we look at the market, the very first thing that you want to do is identify whether you are in a buyer's market or seller's market. To know whether a market is a buying or selling market, we have to refer to the structure that's being displayed on the chart. A buy market displays structure in the following: creating higher highs and higher lows, and we know this is a buying market when price breaks into new highs. A seller's market displays structure in the following: creating lower lows and lower highs, and we know this is a selling market when price breaks into new lows. So what that simply means is that when you come onto the chart, you need to see whether price is creating higher highs and higher lows in the form of candles. So it's always wise, especially for beginner traders, to take this path tool and just go along the candles that is being printed that gives us our market structure. So as you can see, we are in a buyer's market in this range right here. So this on the right here is a buyer's market. The reason why this is a buyer's market is because we are trending higher, creating new highs and breaking into new highs by creating market structure. So to know whether you are in a bullish market or a buyer's market, you want to see the following happen. You want to see price create a high, then a pullback, which is the high low, and then it breaks this area of resistance, creating a new higher high, and then we have a pullback, which is a higher low, and then you want price to break this higher high, creating a new higher high, and then pulling back to creating the higher low. So this is what we call a buyer's market, where price is creating bullish structure in the form of higher highs and higher lows. In a seller's market, we have exactly the opposite. So what we have is price creating lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So essentially, it's the opposite of what happens here. So you want to see price breaking into new lows by taking out the previous low and creating a pullback, which is called a lower high. So you want to see this continuously happen in a seller's market for the market to display a seller's market. So you will see a series of lows being taken and price creating structure in a downwards trend. So we have lower lows, lower highs, lower lows, lower highs, lower low, lower high, and a lower low. So that is what we call a seller's market when you have price creating selling structure in the form of lower lows and lower highs. And if you are confused about the candles, the only thing that you should be focused on is the structure that the candles creates. Because as new beginners, even with myself, I was focused too much on what the candles were doing. I was focused too much on what the candles were doing and how they were looking. So that gave me mental diarrhea basically. So I what I did to make my life easy and my trading journey easy, I what I did was I took the path tool and I plotted out over the candles, over swing high and swing low. I created this type of trend right here and with the path tool. So when you see this, you can literally just go here and you can hide the candles. So then it looks more cleaner. So now you don't have all that noise. All you are left with is the structure. And as you can see, that it's more clear now that what price is actually doing. And once you are done, you can bring back the candles because the candles are there for information, not only to give us structure, but to help us understand in what type of market we are. So after you draw over the candles out at the major swing points, which is a swing high and a swing low, you can start to see that you have a structure that's being plotted out on the chart. So after you have done that, you will then notice that you are either in a bullish market or in a seller's market. So let me just do this so that we can understand that this is a selling market and this is a buyer's market. So what you want to do next is, and if this is confusing or if you are looking for a a better display of market structure, it is also wise for you to always start off on a higher time frame. And then when you move to a lower time frame, things will be more clear. So as you can see, we've got this higher high, higher low, higher high, actually equal highs, relative equal highs. Then we have this pullback, this higher high, higher low, higher, higher low. So as you go down the time frames, these candles will become more. So I advise you to stick to a time frame where you can see a proper display of market structure. Because if you go to the weekly, it's gonna give you something like this, and then it's gonna look like, whoa, what's happening? You know, it's gonna literally confuse you because what's going on? So that's why I refer That's why it's always good to go to a time frame where you can see a proper display of market structure instead of going to a lower time frame or a time frame where there's a lot of noise, where there's many candles, because that what confuses most of the new traders or beginner traders, that they are on time frames where it's not clear what is going on in the market, and sometimes they are trading against the market structure or the trend. They find themselves on the wrong side of the market, getting stopped out because they did not pay attention to higher time frames. So once you are able to spot a market structure, you are able to know that overall that you are in a buyer's market, so you should be looking for buys instead of sells. But you are most welcome to sell in the retracements of price, which is the pullback. So you are most welcome to sell the counter trades or take the counter trades, which are just retracements and pullbacks in the market. But the overall bigger move would be a buy in the upwards direction. So you are welcome to take these trades as well, but you need to be able to understand when these trades are coming in and when the market wants to pull back and all that. So it's important that you understand lower time frame structure as well. And one thing I want to tell you is time is fractal, and what it means is what price is doing on this 3 monthly chart, it's doing on a lower time frame as well, as low as the 1 minute, because everything that happens on a higher time frame happens on a lower time frame. The difference between a higher time frame and a lower time frame is just the time and interval it takes to print one candle. So in this case, a 1 hour candle will print every 1 hour, and a 3 monthly candle will take 3 months to print out. So that's what I'm saying. Within the 3 monthly chart, you will have way more 1 hour candles printing out to create the 3 monthly chart candle. So once you can identify market structure, you are a step closer to being able to become a profitable trader or a or understanding what the market will be doing, and you can basically predict what the market will be doing because you are you have identified what type of market that you're in according to the structure being displayed on the chart. So the next thing that I want to help you with is what to do when you've identified your market structure. So the next thing that you actually want to do is find areas of liquidity. But I don't want to actually speak about liquidity today because that's a whole different topic. So what I want you to do is just look for points of interest. So the point of interest that we are looking at is order blocks. And what an order block is essentially is the last. Okay, let's discuss what a bullish order block is. A bullish order block will be the last down close candle in a range after price has shifted direction. So an order block will be the last down a bullish order block will be the last down close candle before price shifted direction. So as you can see, we have a couple of order blocks on the chart right there. So this will be my last close down candle before, or my last bearish candle before price shifted direction, and then price created another order block before it then shifted either into the upward direction, into the intended direction, into the buying market direction, because we are bullish in the buyer's market. According to structure, we need to still be going higher. So that is what a bullish order block is. It's just the last bearish candle that was formed after price has shifted that direction. And a bearish order block is just the opposite. A bearish order block is just the last closed up candle or the last bullish candle before price shifted direction. As you can see, there's order block, price pulled into it, and then we had this big shift. And also the side, we have another order block up here. And when price pulled into it, it shifted direction, giving us another order block up here. And that pulled into the and price pulled into this order block, and then we shifted again. So that is what order blocks are in simple terms. There is different types of order blocks, like an extreme order block, but I want to keep things simple for beginners and all that, and what a valid order block is. So what a valid order block is, a valid order block is a closed up candle or a bullish candle that is at swing high and also has a fair value gap close by it. So as you can see, this order block right here, right here, has a fair value gap also. So this is a higher probable order block, which means price is most likely going to pull into this order block and rebalance itself at the same time within this imbalance or fair value gap right here. So what makes an order block valid is that it needs to be at swing high or at swing low, and close to it or at it there needs to be a fair value gap. So let's go down to a lower time frame to just understand that how you can use market structure to get into areas. So what you want to do is, since you have this trading range, so this will be your trading range. You will have swing low down here, then you have swing high, and also we have this order block right here. So that will be our 3 monthly order block. So that's what you can do all the time. You can find a trend or a range, whether it's on this time frame or on a lower time frame. It doesn't matter as long as you understand the higher time frame bias as well. So when you have this 3 monthly order block and you have your current trading range, so this is our higher high, higher low, higher high, higher low, higher high, higher low, and price cannot break below this area or this recent lower high, because according to the market type, which is a bullish or bias market, we are expecting price to then create a new higher high because we have pulled into this area, we've retested this order block, and we should be looking for price to then start to reverse. And the way you do that is, so what price will do is create a solid or evident market structure on a higher time frame, and then on a lower time frame which is smaller than this, price will create bearish price action. So you need to understand bearish price action now on a lower time frame, because this bearish price action gives us and makes up the retracement and the pullback. So let me just make this a different color. So you need to understand that in these areas which are called pullbacks, you will have bearish price action, and in these areas which is price breaking into new highs, you are going to have bullish price action on a lower time frame. Let me just make this a different color, make this red. So you need to understand that within this range, you will have bullish price action on a lower time frame in the form of higher highs and higher lows. Like I said, price is fractal, so whatever you see here within this range or this price action, within these big impulsive moves, you will have bullish price action. And when price comes to an area where it's going to start reversing, on that same time frame, you will see bearish price action, because we need to form the retracement. And the retracement will come in the form of bearish price action, and that will be lower lows and lower highs. And in this range, we will have bullish price action, because we need to form a new high and take this high, and that will be in a form of bullish structure. So once we understand that, you can literally like remove things like and clean up your chart. So I'll just leave this for reference. So if we go to the monthly, maybe the weekly, let me just check. Yeah, this is a way better explanation. So as you can see, what I said is you will have one big move on a higher time frame like this, and on a lower time frame you will have price creating higher highs, higher lows, higher highs, higher lows, and then we had this big push up expansion, higher high, higher low. Then we had equal highs, higher low, another high low, high low, higher high. And as you can see, when we okay, let me just redraw this because it looks very bad. Or let me just come into relevance of price starting over here. So as you can see on the weekly time frame, which is a lower time frame, you will have within this you will have within this big impulsive move, you will have a series of higher highs and higher lows. Let me just draw this correctly. You will have a series of higher highs and higher lows until price gets to an area which is the swing high of the 3 monthly chart. So if we go back here, you will see that this is our swing high for the 3 monthly chart. So that's our higher high up there. And once price creates a higher high on the 3 monthly chart, you can pop down to a lower time frame and actually see what price is doing there. So it looks like I won't be able to get everything into this video, but I'll probably have to make another video. So when you go back to the weekly, you see up here is our swing high, which was our higher high before price wants to retrace. So once we got into this area, we started like all the way into this swing high. We created higher highs and higher lows. And when price pulled into or created a higher high, we started to reverse from this point. So we created bearish structure like this. So this was our bearish structure until we got a change of character, which means now price has created its pullback, which was the higher high, higher low, and we had a change and a mark structure shift to then start creating this new higher high. So we had a higher high, higher low, higher high. So I'll continue this on